Ah là 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 là. Okay, can you hear me? And when I breathe, does it sound like... Okay, maybe a little bit lower. Yeah, so it's better. Je me fatigue déjà à m'entendre. Je vais mettre des bouts de caisse. Un peu intérieur. Non, après si j'ai chaud. Ça. Non, c'est bon, merci. Je sais pas si t'as vu, il y a eu une photo qui tournait sur internet à un moment, c'était genre Kylie Minogue ou je sais pas quoi, il y avait un assistant qui lui mettait des petits bouts de scotch là pour que la robe elle restait comme ça, il disait que c'était les blagues sur internet en mode le mec a le meilleur job du monde. Ok. Je suis pas en live là. Dis-moi hein. Je parle pas de... C'est vrai. Tu m'entends là? Cool. Normalement, oui. Excuse-moi. Pas que je sache, non. Hello? Hello.
Hello, good morning.
Morning. Bonjour.
Buongiorno.
Buongiorno.
Hello, good morning to everybody from the amphitheater of Min Paritech here at Sofia. So I give the floor to the president of the jury, Miss Professor Angelica Gianfredda, to introduce the session. And thank you, Angelica. The floor is yours.
Thank you very much for giving this opportunity to be the president of this PhD committee for the defense of the PhD candidate, Valentin MAHLER, today. Let me introduce and briefly recall the procedure of today. We have the jury, so the PhD committee is composed by two professors who acted as a rapporteur. Yannick Peretz from Central Supelec. The other rapporteur is Leonard Soder from the Royal Institute of Technology, myself from the University of Modena Reggio Emilia, and the other three examinators are Richard Green for the Imperial College of London, Michael Pollitt from the University of Cambridge, and Philippe Vassilopoulos from Apex Sport. And then we also have the PhD supervisor, co-supervisor. So Valentin will have 45 minutes for his presentation, and we are going to leave the floor, or the microphone, to each rapporteur for 20-30 minutes for asking questions. Then each of the members of the PhD committee will have the opportunity to ask questions to the candidate, and at the end of the process, at the end of our discussion, I will open the floor to questions from the audience, but I'm afraid that we have a strict constraint that only people with a PhD can ask questions to the candidate. And we should conclude all the discussion by noon. Okay, so I'm going to leave the floor to our candidates today. Valentin, the floor is yours.
Thank you very much for this introduction. I would like to present my PhD about modeling the evolution of electricity prices in a context of high penetration of renewables in the electricity market. This work has been done under the supervision of Robin Girard and Georges Karinotakis. It has been prepared at Mines Paris Tech, member of PSL University, and most precisely at the Per Se Research Center. The presentation will follow the following outline, where we will start with an introduction about the motivation for this thesis and present the general context about electricity markets and power system, and then specify the scientific objectives. Then the three successive parts will present the core of the research, which is the key component of the modeling of electricity prices. Then some enhancement that would be made to mitigate some of the limitation of this first phase. And then, having a validating model, we will present how it can be applied to prospective studies. Finally, we will conclude by summarizing the key findings of this work and propose perspectives for future work. Let's now start with the context and objectives. So, renewables are a key element of the energy transition. And in order to foster the deployment, we have to ensure that they are economically sustainable. That's why feed-in tariffs have been introduced as a form of subsidy, where renewable energy producers benefited from a fixed price known for years in advance, so that they can make business plans without having to account for this uncertainty and benefits from revenue that can be known quite well in advance. Now, due to maturing of technology and other facets of the evolution of market and power system, the regulation is evolving and the renewables have to sell on market, which means that they are exposed to merchant risk. And not only they have to account for the evolution of their production, but also they have to anticipate evolution of prices in order to make relevant business case. That means that they have to find a way to reduce uncertainty regarding the revenue they can generate over the lifetime of their investment to ensure a positive return on these investments. So these are one of the main reasons why it's interesting to model electricity prices. And we have to keep in mind that to make a relevant analysis, we have to consider a fine temporal resolution in order to make precise assessments, and also that the price on the electricity markets is strongly related to the state of the power system itself and the evolution of technology on its usage. So we have to account for the reciprocal impact of market on the power systems. To go further with this example for renewables, we see that for PV, so photovoltaic energy producer, what's important is not only the general trend of prices, but really the value of these prices around lunchtime, that's where the solar production is at its peak, and the revenues are related both to production and prices at this time. If we take another example for storage, the asset owners generate revenue from the variation of prices by performing arbitrage, meaning that they buy when they expect the price to be quite low and resell at higher prices. And the need for modeling of prices is not limited to this, but also we can cite the need to have a forecast for electrolyzer to develop hydrogen and so on. Not only this consideration about price are important for market participants, but also for policymakers, because they have to ensure that over long term, but also on all time scale, there is a security of supply, and then that all key market participants can have fair market conditions. So they need to make sure that the market design is suitable for the new system condition, and also that the appropriate fiscal policy and support scheme are in place. And finally, what I presented here implicitly was the day-end market, where we have a single price per hour. But having a good model of these prices is interesting also to make an assessment about the possible value of electricity on other related markets that I will present now. So if we look at the general structure and sequence of electricity markets, we can distinguish between over-the-counter, where market participants make bilateral agreements and make contracts on a case-by-case basis. On the exchange that we know, for example, from stock exchange, where we make offers and bids on through an algorithm. We say if our offer is accepted or not, and at which price. And there are also dedicated exchange for electricity markets. And the trading does not occur at single time point, but through a series of markets. And for time more than 2 years before delivery, we call long or mid-term market, which are a derivative. And then just 1 day before delivery, we have the day-end market. And finally, just a few hours before delivery, we have intraday market, where one market participant can adjust the offers based on the latest forecast. Also, just to keep in mind, the electricity system is not purely in the end of market. Ultimately, the system operator, like RTE in France, has to make sure that there is a security of supply, so he can take the final decision about the way the system has to operate, and he manages his own last-minute markets. Just now, to go back to the day-ahead market, which will be the focus of this thesis, we explain that all bids are made 1 day in advance before a deadline, which is called the gate closure time, and they are collected, and then through the algorithm, they will be sorted, and the best from the economic point of view will be kept in order to set a fixed point for each hour of the day, and all the accepted and rejected offer will be specified by the exchange operator. To now illustrate even more precisely how it's working, we find back our order book, where we represent the different sell and buy orders made by market participants at defined volumes and for price that they are ready to pay or to receive for electricity. And then the algorithm will take the lead, and basically it will perform an ascending ordering of order for the supply curve, so the sell orders, and descending order for the demand side. Then these two curves will define an intersection point for each hour, which will help us to identify a market clearing price on accepted volume for each hour. To which extent it's interesting is that all offers on the left of the accepted volume will be considered accepted, so we call them in the money. That means that the green orders will be effectively traded. And what's important to note is that the transaction will not occur at the initially submitted price. They will all be at a unique market clearing price, which be lower than what they were ready to pay for the demand, and higher than what was bid from the supply side, meaning that all accepted orders are satisfied with the final outcome. One last remark is that this is, we can consider a purely financial point of view, but there is a strong link with what's going on in the power system itself, because we know from economic theory that the optimal bidding strategy is close for each market participant to make offer close to the marginal cost, which is the cost of producing one additional unit of energy for this specific time point. And this helps us to understand market and to draw the link in models between what's the power system and the electricity market. Then having this information about technologies, we can remark that we have a marginal class for each hour, which is the one setting prices, and that will be useful for the modeling also. If we now introduce a way to model time series of prices, we can propose to use a structural model that will try to mimic quite closely what we explained about the functioning of the market, and will perform this mathematical optimization of social welfare. So basically meaning that both suppliers and consumers are satisfied with the market outcome. And then we can identify different categories of techno-economic inputs to be used for the model, and that are really relevant for the development of energy markets. For the supply side, we have production, everything related to installed capacity and availabilities and so on. Then the second, third, and fourth point are related at the interface between supply and demand. So it's related to the electrical grid, the use of storage, and other energy and emission markets like gas and CO2. And finally, last but not least, we have everything related to consumption, especially at the national level. And to do this kind of modeling, we will have to rely on database that gives us information about the way the system is empirically functioning. We have, on one hand, the power system data, which we can differentiate schematically between static data, which are the overall structure of the energy system, and also dynamic time series about the normal functioning of the system for production, consumption, storage, and grid, but also more unexpected events about outages or maintenance. And this information will be drawn from official database. So ENTSO-E has a legal mandate from the EU to provide this data. But also there is a trend for open data, and academics and industrial alike propose new structure on clean database, such as for open power system data. On the other hand, we have market data, so we can exploit and leverage historical energy prices. So for electricity, obviously, but also for the oil, gas, and CO2 markets. And these are only the market outcome, but we can go one step deeper by analyzing the supply and demand curves that form these prices and have incorporate additional information. But now that we have collected all this data, we can be tempted to directly use a purely data-driven model, where we will not really account for the way the prices are effectively formed on the market, but use a more statistical approach or neural networks or regression trees on such more general approaches. And to do so, we proceed in two steps traditionally. So we have what we call a training phase, where we reuse a real market outcome, and we will be able to estimate model parameters using a first subset of all our data. And then, having this estimated parameter and reusing a second set of data, we will be able to simulate time series of electricity prices. Both approaches have advantages and disadvantages that I would like to quickly summarize. So for structural models, we really have a high interpretability, which gives trust in the approach, because we get really close to the way the power system on market are functioning. The corresponding drawback is that we have to make quite a lot of techno-economic assumptions. We have to really try to understand how the system is working. On the other hand, the data-driven model are more agnostic about the way markets are working, but they intrinsically are strong when to capture the correlation between input on price driver and output, which is interesting, especially for short-term forecast. But the corresponding disadvantage is that we are not sure if they really learn structural or conjectural patterns from the data. And so if we want to actively simulate change in power system on market design, they are not necessarily well suited. Looking at the way this model operates, we can highlight a key difference is that for structural models, we have quite a lot of parameters that have to be defined by an expert that know about the market and power system. Whereas, as mentioned, data-driven models directly learn from the data. So what we propose here is to bridge the gap between these two approaches and to take benefits of both in order to estimate parameters of the structural models by statistical approaches in order to leverage historical data, which leads us to our scientific objective, which is to propose a structural model enhanced by statistical approaches in order to improve simulation of hourly electricity prices and the event markets. The remaining of the presentation will be structured as mentioned during the outline. So now I will start with the key component of the model before proposing improvements on apply it to prospective studies. Regarding the modeling, first we will focus on the general model architecture and the way we propose to model prices, and then we will illustrate its validity on a case study. For starting from the overview, we find back our inputs model on a simulated time series of prices, and we will introduce a key component which we call market clearing with technical constraints, where we will really implement this mathematical optimization about the maximization of social welfare, while also accounting for additional constraints that are imposed on the power system, but that also reflected on the price formation. We don't want to rely on pure optimization. We also want to learn from data. That's why we introduce the parameters of offer prices on the correction of bias, as will be detailed later on. And finally, to have this parameter, we need to develop dedicated estimation algorithm that will help us to learn from historical data. Let's now focus on the key optimization part. So we have our power system constraint that we impose to the system, and we also introduce more the financial aspect and the market-based aspect by introducing the offer prices. And as an output of this optimization, we have the key component, which are market clearing prices for each hour of the day over long time periods, but also we can identify time series of hourly marginal classes, which will be especially useful to estimate model parameters. And if we look a little bit under the hood, we will find back the objective, which is to maximize the social welfare. And we introduce the first constraint that is key and reflects the fact that on power systems, supply and demand have to be balanced at any time. And what's interesting, it's obviously we find it back on when we adopt the market perspective, because for every buyer, you have to have a seller, and you also have this kind of balance. We have other constraints about the way power system works, but we'll focus on the last one, which is the hydro stock constraint, which is related to the value of water. The difference for hydro reservoir compared to thermal generation, for example, is that the marginal production cost here is quite low. So we can be tempted to say, okay, it has to produce at every time step because it's really interesting for an economic perspective, but that would be neglecting the fact that the stock of water is not unlimited. So the producer have to use it strategically. So in order to make sure that they can produce when prices are expected to be higher and not so to benefit from this opportunity cost. So in order to optimally manage their stock. And it's also interesting from a modeling perspective because this constraint creates a coupling between hours that is not necessarily seen when we present the simplified market clearing mechanism, which is to consider each hour separately. Here we have an additional coupling constraint. If we now move on to the modeling of parameterization of offers, what we propose is to consider 4 main price drivers. The 2 first ones are related to operating cost. So more precisely to fuel cost and emission costs. Fuel cost will be specific for each technology. So we will take the price of gas for gas power plants and the price of coal for coal power plant and so on. And emission costs are the emission allowance for CO2 in Europe. So this impacts the way the marginal costs are evolving for each technology. Then we introduce the supply margin, which is more on a higher national level. It's the difference between the aggregated available production capacity and the demand for each time. And when this difference is small, that means that there is not a lot of room to add additional demand because all production assets are already engaged in production. So for the last few remaining units, there is an incentive to bid at price a little bit higher and to operate strategic bidding. That's what also we want to introduce to reflect in prices. And finally, we have a proxy variable that represents the variability within a class. So if you consider all gas power plants, some have been built decades ago, some are more recent, and they have different conversion efficiency, which means also that from an economic point of view, they are not as high or low in the merit order. So in order to have really this variability in prices, we want to introduce a variable to represent this variability. And coming from these price drivers to the offer prices, we need to introduce parameters which are specific for each production class, so nuclear, gas, and so on. And we proceed by doing a linear combination between these price drivers and the parameters. Now we will come back to the overview of the model chain and explain how we estimate parameters. So it's an iterative procedure done in 2 steps. In the first step, we initialize the parameters and proceed to a first simulation. Then, having our market outcome, we can reuse real data during the training phase and perform the estimation, where we will produce a new set of alpha and beta parameters that can be reinjected in the model in order to perform new simulation, changing the simulation price on the marginal classes. On doing so, we can repeat the process until reaching satisfying values. And to be more precise about the update of parameters, for the alpha, we will perform a constraint regression between observed prices and price drivers. And why constraint? Is because we want to keep the interpretability and the logic between price formation. So for example, we want offer price for electricity to increase when the fuel cost is increasing, so that we impose alpha to be positive. And the same logic apply for all parameters. Then we have the beta parameter, which helps to capture additional factors that are not in the initial input, because we observed, and it's known in the literature, that price display typical patterns at the weekly and daily time scale. And what we propose here is to estimate the mean error that we have in the simulation for each hour of the day and day of the week, and then to have a final correction to improve the simulation outcome. Now that we know about the overall model architecture, I would like to present how it's been validated. So we reuse real data for France for the period ranging from 2015 to 2018. For the supply side, we consider the available power for each generation units. So not only the static install capacity, but also information about unavailability such as maintenance. And we consider 5 production classes with our hydro reservoir, nuclear, gas, oil, and coal. For the price driver used as input, we find back what we presented during the estimation of parameters, which is listed here again. And for the hydro stroke constraint, we assessed estimated what would be the maximal production for hydro reservoir over a period of 1 year in France, and we imposed this as a first as a total constraint on the system. Then, as we have a unique bidding zone and we know that power system and market are interconnected, we have to fix a boundary condition. Is this first case study? So we'll take the assumption that we know this boundary condition and that we know the prices on neighboring countries and also the transfer capacity at the interconnection that will make the exchange of energy possible. And finally, we find our demand, and it's a residual demand in the sense that we use the hourly forecasted demand at the national level, and we will reduce some production side factor, which are renewables, which will be considered price takers for this time period in France. Also, we will assume that we know the production patterns of on the production time series of pumped hydro storage. Then cogeneration, especially for gas, we will consider that it's not really elastic with regard to the day-rate price, but it will be more driven by weather condition, because when we mean cogeneration, it's generation of heat and electricity, and the need for heat is quite stable and not very variable with the day-rate prices. So we'll consider it as an input of the model. And finally, biomass will be considered negligible for this specific case study. If we know, we go into more details about the way we perform the simulation. So we find back our 2 steps where during training we use 1 year of data in order to estimate our parameters. Then we use a different year in order to simulate using the corresponding inputs on a parameter that had been trained previously. And we will compute 2 metrics to follow the performance of model. We have the root mean square error in order to evaluate the overall performance of the model to capture the simulation globally. And then we compute the difference between the standard deviation of the real prices and the simulated prices in order to assess if we capture the price dynamic correctly. And these are the results that we obtain out of samples, so doing this cross-validation. We see that generally the price variation at the weekly and hourly time scale for each day is captured on average, and also above we see that the simulation in red follow the observation. Just we can remark that price spikes that occur occasionally are a bit harder to capture well, and especially to really get the right amplitude for the spikes. If we also now compare the results of our simulation to other models, we can start by estimating the effect of having the calibration of model parameters. So to do so, we look at the red dot, and we see that the white one, the hollow one, is higher than the red one, which is after calibration, which means that the performance were a bit worse when we just take initial parameters, so initial values for the parameters, compared to what we do when doing the whole estimation phase. So in order to have the best results, we need to be as close as possible to 0 on this graph. So the fact that we are below the white dot means that the estimation improves the out-of-sample performance. Now, if we compare our model to a purely data-driven approach, so whether statistical or machine learning, we see that when we compare to the two triangles, we outperform them, but that's when the model only use technical data to simulate prices. As soon as we introduce the price of neighboring countries, it's hard to beat this model because they are intrinsically good at capturing this kind of correlation, and we know that the price in the French market is related to what's going on at neighboring markets. So to conclude this part, we presented a method that we validated on a case study, but we also highlighted that there is still improvement to be done before moving on to more general case for prospective studies, and that's what we will present after. Still, we have the fact that statistical learning and the estimation of parameters improve the accuracy of simulation out of sample. And also we see that the model is able to capture the dynamics of prices. So not only general trends, but the way they are evolving with a high temporal resolution. Even though the spikes are a bit harder to capture well. And now we will present model enhancement in two ways. First, we'll present how we can extend and further explore the estimation algorithm. And we will also see how we can have a more accurate representation of the power system itself. Regarding the estimation algorithm, we propose 3 complementary studies. First, we perform a sensitivity analysis to see to which extent the initialization of the merit order during the training phase impact the performance of the model out of sample. And what we've shown is that it's really important to have initial merit order that are in line with the economic theory and the literature, and not to initialize this parameter randomly, because it's the estimation accounts for the marginal class within the process, and we have to give information. So the modeler has to give reliable information when initializing the model for the training phase. Then we also shown that we have ways to improve the simulation with regard to extreme prices. We want for during the training to give specific weight to higher and lower, really high and really low price, in order to make finer adjustments of the parameters. And that's why we can select differentiated weights that will be gives more variability in the cost function, and will ensure that we take the higher price with more consideration when estimating parameters. Finally, I will present with more details the data augmentation studies that we propose. Well, what we mean by data augmentation will be to find ways to retrieve information from real supply curves, because for each hour of the day, we have only a unique market clearing price that comes from the observed time series, and that will come from this intersection between two curves. But what we can do is introduce small delta variation that we will impose, and that will define a new synthetic volume corresponding to an increase or decrease of demand. On doing so, we can create new synthetic or so artificial market clearing price for each hour. On repeating the process multiple times, we can create time series of market clearing prices that will be quite realistic and can be used for our training phase. On doing so, we use this time series in order to estimate our model parameters, and then we test the performance. And what we observed is that by introducing multiple synthetic data sets, we can improve the overall quality of simulation, but at the cost of there is a trade-off on the dynamics a little bit degraded here, and that's why we observe the Pareto front on the results, where improving one aspect leads to a little bit of degradation on the other one. Also, for the system representation itself, so far we consider that plants had an unlimited flexibility. That means that the production at time t was independent from what's going on at time t-1. and that was not necessarily the most realistic assumption. So we want to introduce this constraint that impose new factor on the price formation. Also, input, so the pumped hydro was considered as an input so far, and we want to change our approach in order to really compute it within the model. That means that we add additional constraints about the way pumped hydro is supposed to work, and then this value of production and consumption are estimated by the model itself. Finally, we presented the case on test case study only for one bidding zone, and we impose a price on neighboring countries. Now we want to have a multiple bidding zone approach where we simulate prices simultaneously on different countries, and this relieves this need for this assumption. So we propose to do it using 3 bidding zones, so in France, Belgium, and Germany. And we see that doing so, we still capture the dynamic of prices, even though we will use less ground source input for the production of pumped hydro on the price in neighboring countries, but still introducing a RAM constraint that impose additional information about the way prices are formed, while not enough to really improve the way we capture price spikes. And if we look at the progressive augmentation of the model, we see that at no stage we really degraded performance by relying on less ground truth. So to conclude this part, we see that we have, by using real supply curves, we are able to improve the accuracy of the model by more than 5%. And doing so, we can extract information about so to go beyond only the time series of prices, but really go one step deeper. Also, we still capture the overall price dynamics, even when relying on less ground truth input. And finally, we have to remark that introducing this multiple zone impose computing constraints. So the increase of computing time is not linear with the number of zones, and because the number of constraints is kind of exploding in an exponential way. And if we want to scale at the size of Europe, we will have to have more IT consideration, for example, regarding the use of database on processors, and maybe move on to distributed computing. Now we can see how the validating model can be applied to prospective studies. To do so, we will have to propose way to build scenarios about possible future energy markets, and we will see how we can analyze the proposed results. So we started from the values for the energy system in 2018 in order to have reliable data at the start, and then we propose variation of this initial case in a reference scenario when we increase the total electrical demand by 20%, corresponding to electrification of usage. And we also propose an increase in wind and photovoltaic for the installed capacity. Then, keeping this both increase, we also decline the reference in 3 alternatives. We had what we call the nuclear policy scenario, when we simulated a phase out of nuclear power in Belgium and Germany, and when we will add the equivalent of 6 new EPRs in France, so new technology of nuclear. Then we have a hydrogen deployment scenario where we will see the impact of having a hydrogen production in Belgium, Germany, and France. And finally, we have what we call the high operating cost scenario, where we will assess the effect of having a simultaneous increase of all OPEX on energy and on the emission market. So OPEX means operating costs or expenditures. So these are the what-if scenario, where we set in advance the way we consider the system can evolve, but it's deterministic, and we also have uncertainty in the way the power system will be used. meaning that we want to find a mathematical way to represent this uncertainty, and that's where we introduce Monte Carlo simulation, where for variables that are not well known in advance, for example, weather patterns or unavailabilities of power plants, we can produce new time series used as input by performing random sampling from our initial database. And to give an example, if we have a PV load factor for the year 2015-2018, and we have one value for each hour of the day, we can create the first variant by doing a random sampling for each hour, which will generate a first time series. Then we'll make a second one until having our 30 variants of input that can be applied to each scenario. And this approach helps us to simulate new time series of prices and consider possible futures, where we still observe this similar seasonal variation as intended, as we can see. And also, if you are not familiar with this kind of plot, what we see in blue is the uncertainty, where dark blue represent the most likely values, and light blue represents what could happen in case of extreme situation for the production or demand side. Also, having this approach, we can compare the effect of different scenarios. So here we have the same week in December for the reference scenario on the one where we consider the impact of hydrogen. And what we observe is that due to this hydrogen, which are considered quite a low marginal cost on that operate price arbitrage, we have for this week overall increase in prices due to additional demand. But if we focus on these higher prices, we have, so for the time when the price were higher in the reference scenario, there are slightly decrease in the hydrogen one, because we have this additional production that will a bit reduce a little bit the cost. On the other hand, for the demand, the low price will be now a bit higher, because there will be an additional demand that will push a little bit the merit order to the right. To conclude this prospective section, we see that we can now simulate time series of prices with associated uncertainties that gives us a way to detail, to perform analysis and give us information about possible future prices. Also, having these scenarios, we can really compare the impact of having a change in techno-economic factors. And finally, the scenario building approach is quite generalizable and can be extended when using a new and complementary data set coming from open data, or if additional proprietary data are available, they can also enrich the simulations. Finally, I would like to conclude this presentation by summarizing the main points and also giving perspectives for future work. So we propose an innovative data-driven structural model in order to simulate prices at the EU day-ahead markets. Our approach allows us to account for market clearing and also for the power system constraints. We propose to have an hourly resolution and to simulate over many years on the multiple bidding zones. The way prices are formed and represented in the offers is parameterized and also extensible in the way we define the parameters or the price drivers. We introduce a dedicated algorithm in order to learn from historical data and propose an estimation that can be reused for different prospective or counterfactual studies. And the method is not only theoretical, but it's been validated on empirical data. We also illustrated how the model performs and can be used in prospective mode. So we see that the model design allows us to account for the evolution of key techno-economic factors. And also, as presented in the introduction, this kind of simulation outcomes are relevant to evaluate business cases on energy policies. This work can still be extended in the way the model is developed. So for the supply side, we can consider to go more precisely towards a unit commitment by considering start-stop constraint for production assets that also have an impact on the dynamics of prices. For the grid side, we can also model them more precisely and go closer to a flow-based modeling, where we will also consider the impact of having an energy reserve on line congestion and so on. For the parametrization of orders, we can see that there is also room for improvement, and we can try our alternative approach by introducing nonlinear parametrization. Also, some of the current improvements would be to move from a price taker approach for renewables, because now they are considered within the residual demand. And if you want to go towards simulating 100% renewable scenario, we will have to account the strategic bidding of renewables, where we'll not only produce at a marginal cost, but they will have their own dedicated model, some model to form prices. Also, for the demand side, now it was considered quite inelastic with regard to price, and we can go one step further by having the same approach of parametrization also for demand side. And finally, we focus on the day-end markets, and we know that there are interactions, for example, with the day-end market, where market participants can be tempted to bid on those markets and also perform arbitrage, and we can go deeper and see how this could be accounted for and studied. The last aspect is about prospective studies. We can keep going in this way by extending the spatio-temporal scope, so considering more years on all countries in Europe that will need to collect additional data. And to do so, we can also not necessarily keep improving our model. The other complementary approach would be to reuse the insights, so how to parameterize offer, how to train them, so to estimate parameters, and then to integrate this principle into more mature tools, such as Antares from RTE. This work led to a scientific publication in a journal, Energy Economics, and also it has been presented in a conference at the European Energy Market Conference in 2019. I would like to thank Adem and Armand for funding this work, and I would like to thank you all for your attention. I welcome your questions.
Thank you very much, Valentin. So now I give the floor to the first rapporteur, Professor Yannick Perez.
Thank you, dear President. I would like first to thank the two PhD supervisors and Valentin to have invited me in this jury. I enjoyed a lot the reading of the PhD. I've learned a lot of things, which is good. When we read a PhD, we want to learn new things. So there's new things in the PhD, and it was very surprising for me to see how it is possible to go straight to the point. You want to deal, because as an economist, we used to put a lot of debates on a lot of things, and sometimes we are lost in the debates, and we have some difficulties to go directly to the question we want to analyze. So I would like to take this lesson from your PhD, and I will try to go right straight to the point, as you did. So my comments, my first comments is to say that the PhD is very interesting, and that all the questions I will raise don't have to let you think that I don't like the PhD, and it's mainly because I like it that I will raise some questions and comments, and maybe to try to think about possible improvements or possible questions that you could maybe follow in the future, depending on which future you will want to have or spend your time on. The first thing is my first question. It's a remark and a question. It's what a day to present a paper or a PhD on modelization of prices. In France, we are today at 3,000 euros per megawatt hour. So it's impossible to be more timely than today for making this presentation. When we read the PhD, of course, the question we want to see is how you can analyze the spike prices, because we are suffering in France from the last weeks very high prices that we never have experienced before. 3,000 euros, I think the last time was in 2003, when we have a very hot summer and most of the nuclear facilities out because it was summer and normally they were not used. So today we have the same problem, but nuclear is not used because basically it's not working efficiently. So my first question or my first comment remark is around these spikes and the fact that for most of the PhD you are trying to say spikes are a problem and I want to deal with them, but at the same time there are very few moments in which we have this spikes price, so how to deal with them efficiently, and it's a sort of your problem. And my feeling is maybe if you want to improve your PhD on that question or the future work on that question, it's probably to move from the first hypothesis you have in your modelization, which is that everyone is price taker. That you have the assumption that we are in the game in which, to make it simple, we are in pure and perfect competition, and then that the behavior of people is supposed to be just price takers, which is in the French case, and trying to analyze the French prices, probably one part of the problem. And what I find interesting in your approach, I would say is to say what we cannot explain is probably due to strategic gaming, because what you try to do is to explain which part of the prices could be explained by, let's say, usual technical economic things and the past prices, and we take into account for most of the technical issues. So what remains unexplicable or what remains non-explained by the model could be strategic gaming. So maybe it's not a bad news not to explain the spikes, but maybe it's a good news because you say, okay, this is the limit of the pure and perfect settings. It explains 50% of the price and the rest is not explained by pure and perfect competition setting, but by strategic gaming, which is maybe a good news. I don't know. Maybe it's a good news for regulators to have a tool to make the difference between high prices due to technical reasons and high prices due to technical reasons plus strategic gaming at the time of technical issues. Then my second comment or second question is regarding the fact that you go very fast on a lot of questions on terms of market design. There is a lot of debates in the literature. I'm not going to spend too much time on it, but there is a lot of debates in Europe to go from zonal to nodal pricing, where we could get closer, etc., etc. And really, you rush to your point, but sometimes I have the feeling that maybe you rush a little bit too much. So my first, let's say, question is. And I will take it from the report I send you, is you assume page 45 that the price of electricity are very volatile, which is today quite true. But you say that it's more than over commodity markets, which is probably something that someone could say yes or no, but probably in your PhD you should present us some, let's say, comparative tables to explain that it is much more volatile. If we compare it with the oil market, if we compare it with corn or etc., Maybe just to say it's volatile, it's not enough. You have maybe to try to characterize this a little bit more. My second is you assume that price sensibility is equal to 0, which is, of course, almost true. Because today, if we make the calculation, the price sensibility between what was forecasted yesterday in terms of electricity consumption and what we have today is a -2% with 3,000 euros per megawatt hour price. So on the very short run, I do agree with you that price sensibility is quite low. It's not 0, it's 2%. But 2% is, you could say it's close to 0. But maybe there is a problem in terms of time horizon. I do agree that for tomorrow morning, we cannot do a lot of things. For the next 3 months, for the next 6 months, for the next year, maybe some people make an anticipation of these high prices and make changes in their consumption patterns or try to make investments to reduce their consumption. And I would say that as you are doing things over years, taking into account the fact that each hour you don't have price elasticity is correct hour per hour, but over the years, there is probably an issue to deal with. Then if we move to chapter 4, this chapter 4 is of course the main piece of your PhD, which is very interesting. But I would like you to discuss some elements. For instance, the first one is you have a phase test, a learning test, which is for 3 years, and a test, which is for 1 year. Okay, why not? But why not 2-2? Why not 3-1? Why not 10-1? 21? Well, if you change a little bit this design, does it change your results? That's one of the questions that I would like you to discuss. And the second point, which is linked to that one, is the fact that, in fact, you study years from the 1st of January to the 31st of December, which is logical if we take as a standard the calendar year. But in fact, as you want to capture the behavior of nuclear fleets, I think you introduce yourself a problem, which is that our nuclear fleet is not managed from the 1st of January to the 31st of December, because the functioning of the nuclear reactors is around 12 months plus 6 to 8 weeks to refuel, and we need them in December. We need it from let's say November to April. So taking the decision, not taking into account this different views in terms of season, I think creates a problem in your selection and in your results, because the farther you are from the beginning, the more this causes problem, because in fact you would probably have better results if you start your simulation, let's say, I don't know, in June, from June to June, instead of from September to September. Well, I would like you to test the idea of not starting the 1st of January, but probably to take nuclear years instead of calendar years. Then in your results, you seem to highlight the fact that there is two bias, an underestimation of the peaks and an overestimation on normal time. And I would like you to reflect on are the same problems having a common roots, or do you think it's two problems that needs two different solutions in terms of thinking or in terms of modelization? Then the last chapter, it's very interesting because you try to use your model to make forecasting, which is of course very, very, very valuable, but risky, because each time we are making a forecast, we take the risk that the future proves that what we forecast wasn't right. Let's say when we are dealing with forecasting, is to prepare ourselves to futures or to alternative futures in which we would like to anticipate what we should do and what will be the consequences of innovations on this part or this part of the electricity system. So I think you have done a very interesting work to try to go from the hourly prices and the understanding of the hourly prices to the modelization of future prices and future configurations. But of course, it's risky because you could have the actual situation that was not forecastable. And of course, trying to understand a system in which maybe the key parameters will change, like nuclear availability, like gas prices becoming crazy, like your neighbors that wants to invade you. They are creating crises. And this crisis, some people say that the crises are good because we learn things through them. I would like you to reflect on this spikes price analyze and the role of crisis, and to see how our system is, let's say, resilient to changes. But of course, it's far beyond your PhD, which is very interesting and very focused on your key question. And I would like to congratulate you for that capacity to stay online with your research question and not to address other questions. So sometimes we do that. So that's the end of my questions. You could select some of them. You could do whatever you want with, but we'll try to, if you can.
Okay. Sure. So I will do my best to reply to all questions. So starting with the spikes, I think it's really related. We have to highlight a single factor. It will be the margin on the system. So when there is a few remaining production assets to provide the necessary electricity, and that's what we see also now, because nuclear is in maintenance, the demand is high because of cold wave, and so on. And then for the deviation, so the price, not the general trends, but what we can see at specific hours, can be also a deviation from forecast. So if we have an expected event in the system, but fundamentally why prices are so high, if we reach 3,000 euro, it will be not only from the traditional marginal cost, as you say, but there are also some strategies behind that. And it's also, if we go back to the energy market, we don't also have to see these spikes from an economic perspective as a problem, because if we have an energy only market, that's all, for example, oil power plants have to be remunerated. That means that most of the time they will not produce electricity because they are too high in the merit order, but then they have to recoup their investment cost through these high price spikes. That means that the market is kind of giving back for this security of supply. So it's not necessarily something that it can be surprising to have such high price, but it's not something that has been thrown upon, at least from the liberalized framework. So also regarding the reason for these spikes, what's interesting is that they are analyzed by CRE, so Commission de Régulation de l'Énergie, and at a European level also. So they have access to more data and can, as such, perform a final analysis. And they really highlight the fact that it comes also from this, at least partially from this fundamental data. Regarding the market design, it can be a huge discussion and a really interesting one. The most relevant source for me and the most interesting has been the ENSOE Vision 2030, and soon they released the Vision 2050, where they explain why the market would have to evolve, and they consider different aspects from co-optimization between reserve and the power market, and also the difference between nodal and zonal, and reducing the market time units, so coming from 1 hour to 15 minutes in order to better account for the variability of power system and rely on more accurate forecast. All these points are really interesting, and also we see different directions, so not going from something centralized, but having a patchwork of conditions, so not one size fits all, but to make, for example, a market design a bit specific to the Nordic countries and to southern countries, so that it corresponds to the power mix and the demand pattern, while still having an integration of the system, so that we can benefit from the integration at the European level, and not only for electricity, but also with sector coupling. So it's, as you already see, it can go in a lot of direction. That's why I skip quite far on this aspect, but I agree it was really enriching to learn about it, and there's a lot of discussion also for another source of comments. I think that beside the institution like European unions and the official reports, Florence School of Regulation has a regular policy brief where they discuss current trend and limits, and they are quite interesting. For the volatility compared to other markets, it's something that we find a lot in the literature, that electricity prices are especially volatile, and I also wanted to verify this assertion. I didn't quote it, made a citation in the report because I didn't find very the most recent data, but still there is interesting value that I can cite. It's for stock indices. The volatility is around 1%. For individual stock, it's below 4%. For bonds, it's below 0.5%. And for commodities, now oil, it's between 2 and 3%. Natural gas, around 4%. Short-term interest rate, it's almost 0. And then we reach up to 50% for electricity market. So really a huge increase. And the reason is that electricity is not really storable. You have a constant supply-demand equilibrium. That's the main reason why and also it's considered as a basis need, so with a low demand elasticity. So it really follows this demand that's changing a lot. So that's one of the reasons for the volatility. Also the relation between price and demand, the elasticity, is true. There is some, and I can, as you said, it's a few percent. So as the first phase of the modeling, we didn't focus too much information on that. And also it's harder to find reliable data to perform the modeling. But I see an interesting example related to the current crisis. It's, for example, industrials hedge their production, hedge their electricity consumption, sorry. And in some cases, for example, it can be now more interesting for an industrial to sell back their energy at 3,000 euro per megawatt hour than to produce whatever they intend to sell on the market, whether it's steel or end product and so. So this is a form of elasticity of demand to prices. For the learning, I want to emphasize the fact that I did the learning on a 1-year basis and the testing on 1-year basis also. And then what you see in it's explained in the thesis, it's a concatenation of the simulation. And it would be interesting to consider a longer time scale. The trade-off is that we also have to manage a stock of water, and also the modeling at this point is still quite rudimentary because we consider a fixed stock at time t for the whole year, but in practice you also have hydrometry, so pluviometry and so. So already the modeling is a bit simplistic, and if we fix at the beginning a stock of water for many years, it will be even more complicated to simulate accurately. So the trade-off has been to focus on shorter timescales. But one way would be but still we also explored the fact that during the training phase, we also concatenated different time series before estimating the parameters. So it's something we consider, but we didn't go. So we didn't spend too much modeling time on this aspect. And regarding the sliding window, if we train over multiple years, I think the fact that we start in June or in January will not be that critical if the timescale is longer. For the fact that we have for higher price in underestimation on the higher a bias for medium price, it's true it can be related because of the regression curve that will try to kind of find a compromise between both, but that will somehow degrade the performance. So, and maybe we can go to a more regime switching approach. So have something specific to price that will be not only improve this kind of simulation, but also do not corrupt the result for the mean values. But again, since spikes are rare occurrence, it's really harder to make statistical inference from there because of the lack of data. So it's it's a challenge that's worth investing further. Really, I think going further in the direction of the parametrization and the use of margin. For also the alternative futures, you mentioned what can going on because of wars, pandemic, and so. And I would say, at least from the philosophy of the model construction, that's kind of a strength from the model because we try to go as close to a physical reality of the system, and also the way market participants behave, so that one they will bid with relation to the marginal cost and also try to benefit from scarcity and so. So not to stick too much with data. For example, if you observe time series for 2015 to 2018 and just look at the input data, you can consider that CO2 price is not relevant. So you will not draw that much correlation because it's flat. But if you try in the fundamental model really to capture the way prices are formed, then you are less bound to this the past value, and you are maybe a bit robust to future changes. In the way that the behavior of the technical power system and the goals and the way a market participant will try to reach this profit maximization goal is somehow intemporal, whereas data just gives you information about what occurred at a specific time point. So not having a purely data-driven approach can be a way to mitigate this aspect. And so hopefully I replied to all questions.
You did. Thank you.
Thank you too.
Okay, thank you very much. So I'm going to leave the floor to the second rapporteur, Professor Lennart Soder.
Okay, thank you very much for a very interesting thesis, and it was the first time I saw someone that is really trying to develop this with time series analysis or forecasting or what you call it in order to estimate the power price. So I think it was really interesting. But I must, I have some questions in order to understand that I have understood it correctly. First, as I understand me, correct me if I'm wrong, that the setup is that you are sitting, let's say 11 o'clock one day, and you want to estimate the price for tomorrow for the or 24 hours. Is that correct?
Yes. Yes and no, because we want to estimate over a longer time period. So we simulate all year at once, not one day, one after the other, but we use inputs that are time series for 1 year. Then we introduce them all in the model. And as output, we directly have a time series over a period of 1 year with hourly resolution. So 8,760 different values. So we do not repeat the process every day in an incremental fashion.
Okay, so the setup is that, for example, when you're estimating the price for a certain hour, we can take the hour now, for example, between 10 and 11. If you estimate the price for 10 and 11 today, you assume that you have all information about the all production, for example, at between 10 and 11. Is that some kind of input then?
In that case, no. We will. So maybe I will go back to the slide. It will be a bit easier to. Sorry.
Honestly, it has not been so easy to see exactly in your models what is the input.
Okay. Yeah, I saw your comment on the report. That's why I try through this slide to explain it a bit more clearly. So this is for the case study. During the first phase, the inputs are on the left. And we will consider for the supply side that we know not the production, but the install capacity. And so what we will consider is for each plant and within this technology that we know how much power it's able to deliver for each hour of the coming year. So for these for the plants of these 5 technologies, but we will consider that we know the production time series for solar, wind, runoff, river hydro, and so on.
But how can, but this, I mean, if we take pumped hydro, I just went into Ensui here and looked on how you're running it right now, for example. And sometimes you produce 3,500 3 gigawatt, and sometimes you consume 1 gigawatt, and the regulated power is between 1 gigawatt and 6 gigawatt. But and if you are simulating a future situation, how we operate this depends on the price, which means that it's more where you more have the price as the input, and then you know how to operate the hydro, and not the opposite. So I just wonder what. Of course, you can do like this, but what can you use it for?
Yeah, it's so. If we look, so if we go back to the supply side, so here we do not suppose that we know the production for this technology. So I think the only problem regarding a stochastic process is for unavailabilities, and that can be managed through Monte Carlo because we have uncertainty, but we can simulate multiple scenarios in order to see the effects. And for the one from the residual demand, what we have here, as explained, is that, for example, cogeneration, we'll consider it's not really sensitive to daylight prices. And here, the assumption for that case was that renewables are really on the left of the merit order with a low marginal price. So there is uncertainty about the production, but not necessarily at the bidding cost when they are not. So for most hours, when they are not marginal, we consider that they are price taker, and basically that whether simulate their production and fix it, assign it a cost, or we can deduce it from the demand. And your point, for example, for the way that the operation of pumped hydro is dependent on prices because they perform a price arbitrage. That's true. That's really a limit in this use case. That was the starting point of the model that has been improved. And in the second part of the presentation, we presented how we do not assume that we know this time series again, but that we move this variable from the residual event to something that is intrinsically computed by the model. To summarize, the difference is really between the availability of plants and the way they are ready to operate, and considering as input their actual operation.
But so the idea is what you write here, that for what you are showing now exactly on the slide is that you assume the installed capacities and unavailabilities. But do you then, if you take historical data, do you then know the installed the unavailabilities? Do you have these data exactly?
Exactly. That's why I try to present here is that ENSOE has a legal mandate from the EU. And so actually it's every producer that has to provide, when the installed capacity is over 100 megawatt, they have to inform all market participants about their unavailabilities in order not to distort the market. If we take a counter example, if you lose a huge nuclear power plant, and you are the only one to know it, then you can bid accordingly and bid the market, but that's a bit unfair because you do not disclose. So it's
but as I understand, this means that if you take, as I understand, in your mathematical simulations, in your models, if you want to estimate the price now, then in your methods, you have a lot of information exactly of which production you have available right now also. So the idea is more that you assume that you have the input of the production and the demand for each hour, and then the question is, what is the price?
Yes.
Okay. And then the question is, as you showed earlier about, the question is in reality that you should operate them according to the marginal costs. So the idea is more or less to find a supply curve for these kind of different units in order to estimate which unit is on the margin, and then you say that the price is on that level. Is that correct?
That's right. That's the main idea.
But then you come to, of course, the challenge, but that is what you have in your later development. The question is about that. I checked for France now that there is an import capability of 10 gigawatt around, and there is an export capability of around 16 gigawatt. So the trading with your neighbors is extremely essential here. So the question is, how do you set the prices on how you trade with your neighbors? Then you have to model, for example, let's say the country like Italy, for example, we have hydropower and wind power in Spain, for example. How do you consider that without having the whole idea of the system and how you operate the hydro in Spain or Switzerland?
Yeah, so maybe schematically, you are right. These are limitations that you mentioned, the way that at first we assume that we know exactly the way storage is used, and that we assume that we know the prices in neighboring countries. That was a strong assumption that was done in the first part as a proof of concept to even be more explicit. Even before what we presented, we started with the first version that was initial and didn't consider fuel cost, emission cost, and what's going on at neighboring countries and so on. And we realized when speaking with partners also that you have to take into account all these inputs because they influence the price formation mechanism, and they have to be part of the model. So to keep to improve it, we fixed it as boundary conditions. So we say, okay, we have to account for these prices. So first we will say we know them, and we will we will account it for them in the model that way. But we realize that it can be interesting for analysis, but if we want to use it in prospective mode, as you mentioned, for ancillary studies and so on, you cannot make this assumption. You have to simulate multiple bidding zones at once. That means that if you simulate the price in France, you will not consider that you know the price in Germany, for example, or in Belgium, but we will simulate 3 time series of prices simultaneously. So we'll consider that we know known other countries. Just we will simulate the prices for these 3 countries, but then we introduce another corresponding drawback, is that at this point we neglect other countries that are also influencing prices. So you really have a never-ending race between model complexity and boundary conditions, and so to have something even more accurate, we should simulate the whole European market at once, and then we will not have this boundary problem. But then we will have we might face at the moment scalability issue, as mentioned now, and this. So this is something to account, but we mitigate the issue in successive steps in the modeling.
Because, I mean, from my point of view, I think it's extremely interesting to see how far you can come with this one, because this is, of course, it should be easier than to run Antares or any of these kind of more advanced methods where you have nearly units on the individual level, capacities and so on. But anyhow, the challenge is, and then what is also interesting, I think, is to identify what is the big problem, especially for when you, I mean, correct me if I'm wrong, but what you do is that you're estimating the parameters on a test phase, and then you are looking at for the future. But for the future, when you are testing it, in reality, you don't know the wind, you don't know the solar, you don't know the trading with your neighbors, you don't know the nuclear capacity, for example. And then the question is, which is the question is then what are you using as input when you are verifying that your model is good for, let's say, if you try it for 3 years and then you are testing it for a future year, for example. The problem is that in reality it's extremely difficult, because for the future you can never know exactly if you have a period of 2 weeks without wind, or there's a huge amount of wind in Germany, so they are exporting on cheap prices. So the question is, how do you draw conclusions?
So that's where Monte Carlo simulation plays a key role, because we can, on one hand, assume the way the market is working from economic theory and past observation. We can also imagine future energy mix that we will set in advance and define in scenario. But there is also an intrinsic uncertainty that we cannot resolve. As you mentioned, we cannot know if in 10 years there will be 2 weeks without wind, or if there will be a lot of sun at other period and so on. This is something that it's somehow unresolvable. We cannot know. But to compensate for the fact that these are stochastic processes, we will not perform only one simulation, but we will simulate multiple scenarios, and we will also give more weight to uncertain aspects. For example, we will use now scaling up 1,000 time series on the fact that 2 weeks without wind are extremely unlikely. That means that we have only 5 variants where it will happen, whereas we will have 600 variants where wind is quite constant, for example. But still, we will perform the simulation, and for all these cases, and then representing it in blue with the uncertainty, we will, for example, observe huge price spikes when there is no wind, and that will be represented with a high quantile, and that's by using. So this uncertainty will not be a model necessary in the model itself, but through using a wide range of input.
But if you take this time series that you have here, can you just explain to me how you modeled how the hydropower is used? Because you in France you have, what is it, 8 gigawatt of controllable hydro, and then you have 5 gigawatt of pumped storage, something like this, and that is a huge amount of controllability, which in reality reacts on the price differences. So how is that modeled here?
So you cannot see here just by looking at the time series of prices, but it's model. It depends when we mention hydro. So coming back to the ENSOE taxonomy, we have three kinds of hydro. We have a run of river, which as a first approximation can be considered must run, so similar to wind on PV. Then we have hydro reservoir, which are you don't really consider it as a storage, it's just production where you have to manage your stock on the bid based on the value of water on the current market conditions. And then you have pumped hydro storage, as the name indicates, it's used for both production and consumption. And this is really the most obvious case for price arbitrage, because
and is that considered in your model? Is that optimization applied? So you are using the hydro at maximum possibility at peak, and then you are not using it at all at the minimum. Is that what you are considering?
Yeah. So for storage, you have a dedicated so equation, and for hydro reservoir, basically it's modeled as a nuclear or gas power plant. So from the model parameters, except that there is an additional value about the stock constraint over 1 year. So that's what we impose here.
Yeah, just a question if you have tested it. I just went into and looked on France and the hydro run of the river. If you see right today, the lowest value is 3,800 megawatt, and the highest value 6,500 megawatt just 5 hours later. So I have the feeling sometimes that when you're talking about run of the river hydro, you are looking at each station, but how much it produces depends on the upstream reservoir hydro. So I sometimes have the feeling that I think you underestimate the controllability of the. This is just a comment because I think it's you see these data, and sometimes it's the same thing in Sweden where we have a huge amount of hydro. That uncontrollable hydro is in reality controllable because you have an upstream reservoir which is controllable. Anyhow, that are details here.
Yeah, that's true. Sorry.
Just one other thing, which if you look on the what is happening right now in Europe, is that you have extreme gas prices, and the gas prices are in reality, I think the gas is coming in the merit order after the coal. But then because of that, you run more coal, and then the CO2 prices go up. So, I mean, I think you have a close interaction here between the coal prices, the gas prices, and the CO2 prices, which is in reality depending on the ceiling that you are putting on the CO2 emissions. Are you? I think it's very complicated, but is it possible to include that?
So we come back to the question that electricity market are part of a complex adaptive system, and when you do the model, at some point you have to put boundaries, and if you want to, so it's not when we present it with blocks, we have clearly defined inputs on the left and output on the right, but somehow everything is interacting. And here we will consider that electricity price have no influence on gas, on coal price, on emission price, but it's the other way around, and it's taken as input for our model. But you are right that these are related, and what we can do is through the construction of scenarios, you will also find this kind of link if we assume in the scenario that energy and emission markets prices are high. So let's say starting with the hypothesis there will be extension of the war, and the second hypothesis is that will be an impact on gas price, and then there will be a chain or a sequence of events, then we'll see that because the alpha parameters are set to be positive, this will definitely have an impact on simulated prices, and this increase in commodity market prices will result in increased simulated electricity prices. So the question is then, okay, can we then find a new equilibrium and saying since electricity prices are high, that means we'll use more coal on the emission market will increase again and have a feedback loop. At some points, the model is just too big. You have too many parameters, and it's whether untractable or not practical. And from a logical point of view, it's important to keep in mind, but maybe more in the critical analysis of the obtained results than still increasing the complexity of the model.
May I ask you, when your Monte Carlo simulation is by definition an interesting method, the problem is the correlations between different parameters here. And if you, for example, what I at least know for Sweden and also for other countries is that the transmission capability is also varying between different areas, trading areas. And that is in reality, I think, also depending on which production sources you have, because these sources are in reality, these transmission constraints are in reality constructed by the different TSOs that are estimating some kind of base scenario, and then they see what is really possible without having congestion somewhere else in the system, which means that I assume that the transmission limitations that you have between different countries depends on the production. Have you, which is a challenge if you are going to do Monte Carlo simulation concerning the transmission capabilities between different areas? Have you any comment to that?
Yes. So first, regarding the interconnection capacity between countries, that's something we incorporate in the model, and we can also account for the unavailabilities, not only for generation units as mentioned here, but also for the lines because maybe of technical issues or so on. So that's something that would not be that complicated technically to include in the model. You just have to switch from
no, not for the, not, but if you look for the future, I mean.
Yeah, it just yeah, it's true that, so then we can base also find back our simulation, so scenario approach with Monte Carlo. But just on the second part is that here we have something again that's quite independent from the market. We say the lines are available or not, then market clearing happen, and we have a simulation out, or we have a price, even regardless of the model. We have from one side the green and from the other side the market. But now going with the flow-based market coupling in Europe on the extension thereof, we know that TSO have changed the topology of the system, and there is a really dynamic adjustment, and the issue even to collect data and to really understand at the fine level of it works. I tried to explain it in the second chapter of the thesis, but or maybe the third. So, but in the introduction, is that based on the bids, TSO have so TSO on the power exchange are working together, and they know how congestion may arise, and so they change the topology based on what they expect the state of the power system to be, and that will also change the power outcome. So again, it's really an adaptive system, and going from A to B to C to D is it's just a simplified modeling view, but in reality everything is coupled on the borders between concepts are more fuzzy.
Okay, thank you very much. Very interesting and nice answers. Nice discussion. Thank you very much.
Thank you for your questions.
Okay, so according to the composition of the committee, so it seems to be my turn to ask questions and make comments. And first of all, let me thank you for your nice presentation. And I also agree with the other two professors that the PhD thesis is very interesting. And I have precisely 5 comments and maybe suggestions. So the first one refers to the statistical features of electricity prices connected with the autoregressive dynamics, which often is modeled in time series, including the previous prices. Now, I know that you are modeling, your modeling is optimization modeling, so I wonder if you could include some autoregressive dynamics, maybe to describe, to instruct the model where the market was yesterday or on the hour before. Okay, so if is it possible? So going to the second question, the second comment refers to your alpha model. So when you estimate your alphas, especially concerning your capital F for fuel prices and your epsilon T for emission prices. Okay, and there is another, yes, this one precisely, thank you. Okay, so now I wonder, you said that I read the table of your inputs, and so my next questions, my comments actually link to Professor Soder comments. So first of all, I read that you are using gas, oil, and emission prices at time t. However, it seems to me that you collect, let's say, from an external database, and I usually use data stream prices, which are settlement prices determined on the day before around 5. So I wonder if you, since you are estimating the model at time t, you are actually, I assume that you estimated the model before submitting the bits or forecasting the bits, let's say, so before noon on day t. So if you estimate your model from an operational point of view, from, let's say, from 6 to 8 in the morning on time t, on day t, you actually do not observe fuel costs. So probably you should include lagged fuel prices, okay? This is the second point. Third question is about the model estimation, which is related to the Professor Perez's comment, which is actually, is it possible to adopt, since I understood that you estimate your model first on a sample of years, then you change the sample, and also you consider each year individually. I wonder if in this case of modeling, so it's different from the one I adopted through time series, I wonder if is it possible to do a rolling window estimation, in which sense you can somehow adjust for market condition instead of keeping them constant for 1 year. I understand that you have a kind of input which are pretty fat at the beginning, so like the level of water or the installed capacity, but maybe moving up your window, 1 year of window, you can include some sudden events that the markets somehow capture. So I don't know if is it possible. This is a question. Going forward to my question 4, actually it is related to your density plots. The density plots actually seems to underestimate your left tail of the distribution. So now, you know, I'm pretty worried about the left tail because of negative prices. And so actually, I'm not worried much about the spikes, but it's because of my kind of research. And to this, probably there is a misspecification in the model. Now, a misspecification in the model probably could be because if I understood well, you use actual RES production, correct?
Yes.
Okay, so probably it could be that you could substitute your actual RES generation with forecasted RES generation, because I'm aware that you use forecast demand. So probably including some source of uncertainty in the forecasted RES could help in fixing better the details of your distribution, okay, in your results. And this is strictly related to my last comments and question, which is related to Professor Soder comments. Actually, you also use the ordering from your neighboring countries. Okay. You can also construct, I think, a proxy in which you take into account the forecast transmission availabilities, which is available, this data is available on ENSOE. So when you look in the transmissions, you have the forecast transmission capacities over several horizons. So a suggestion could be, first of all, to construct a proxy in which you do not just account for the prices from bordering countries. You can construct the proxy using these prices weighted by the volumes, the quantity that actually is traded. And second, indeed, to consider the forecast, okay? So my overall suggestion, so strictly related to also the other comments, is try to see what happens if you can include in the model forecast address together to forecast demand. In this way, you have a kind of forecast margins, and probably you also can get access, but not sure, because Point Connect provides with a fee the forecast available capacities for technologies, and probably you can improve your densities, your fitting of your simulated prices. Okay, and I think that that's all with my 5 questions.
Thank you. So I will try to reply to all questions. So regarding statistical autoregressive part, I think that's something we could introduce, and especially that could be put as a block, taking as input our simulation, and then having a kind of additional statistical learning to correct this distribution. But we didn't do that here. It's possible to do so, but when we go too deep in the statistical aspect, we face a new danger to stick too much to conjectural situation that we observed in the past. And I think it's absolutely not a problem for short-term timescale, or it's on the contrary, it's a strength, because what will happen in the future is really close from what happened before, so we can learn a lot from this. But for longer simulation, it can be a bit dangerous. So even if we have a better performance in terms of metrics from the conceptual point of view, it's something we didn't insist on with this approach. Then for the price drivers, you mentioned the fact that it would be better to use the information known by market participants before the gate closure time. Somehow it's the same for the forecast of renewables instead of using the real values. That's true, and actually identifying the right cost for energy was challenging for me, and I think it's challenging in itself, and I discussed this a little bit in the thesis, is that it's related to the way market participants manage their production cost, and they do hedging and so on. I could not identify for sure how they procure energy and fuel, and so on which market and at which time point, meaning that I didn't know for sure what were the actual operating costs. And that's also the strength of learning parameter, because even if you don't know, you can try to infer from what is transparent. And lagged price, I think because oil and so the other commodity price are not that volatile, I think it's also interesting from principle and to really get even closer to the way market operates. But I do not expect to make a big difference on the simulation outcome, because the price of gas at T minus a few hours is quite close to what we observed at time T.
Sorry to interrupt. No, I was saying the gas price for our, let's say 3 in the morning for day T is the price determined on T-1 at 5, the settlement price.
So 1 day difference between what I use, I think there is there is a difference between both prices, but for most hours, the delta will be not that big on influencing the end result, I guess, but I might be wrong. Anyway, it will not change the concept of the model proposed here. It would just change the kind of input we use for the final simulation. But you're right, it would be more accurate. For the model estimation, the rolling window, is it interesting? We didn't try that. What I see as an advantage is that we have something that might be more accurate. So same with online learning, we use the most recent data to have something more relevant. The corresponding drawback is that we use a restricted data set to estimate our parameters. So maybe giving a bit less statistical strength and just using information from a specific situation within the window, whereas we can exploit more information from a variety of situations. For the density plot, one of the problems with the left tail is that for this case study, we had a few negative prices in France, and we for the res production, we definitely thought about using the forecast for wind, PV, and so on. We wanted to do so, but we faced 2 issues. Is that for the production, we have only one ground truth, but for forecast, we cannot be really sure. So all market participants can rely on different set of forecasts, so you don't have a unique truth. But even regardless of this consideration, we thought about using data from RTE because we can consider it as a benchmark. And we faced some data quality issues because we start from 2015, which was really the beginning of large-scale transparency and open data for power system due to a new set of regulation at the European level. And we had missing data on the incoherent data and so on. We would rather use something that has been more validated, which is the actual production. But as you see here, we still have the price drivers, and we could even, so using the modularity of the approach, add a new driver, which are forecast errors. And we can see, okay, if we expect a change in the production compared to forecast from renewables, what could be the impact on prices? And that's something that we can also learn from data and then simulate with Monte Carlo. Yeah, and I think the last question about neighboring countries, we did something maybe a bit similar to what you say, is not only to use price, but the transfer capacity. So I didn't insist during the presentation, but we have not only the price, but the limitation and of transfer capacity. I discussed previously. We can also have a temporal variation of this capacity. So we already have, but we can do it even at a finer time scale. And that's also one of the reasons why the statistical model performed better in this benchmark than what we did, is that they are not, they didn't have any constraints regarding power transmission. That means they can basically say, okay, I will simulate the French price using the value of the German price, and that's it, for example. Whereas here it would not be possible. We still have this power constraint, and we have to respect the fact that we have a power and supply demand, and using an interconnection alone would not be enough to reach this this equilibrium. And I think that was an answer to your last question.
Thank you very much. Yes, indeed. So now I give the floor to Professor Green.
Thank you very much, Madam President. And thank you, Valentin, for a very interesting thesis, which I've enjoyed reading, and definitely a worthwhile project. So congratulations on that. Could I ask, when you were doing the regressions to get your adjusted bids, effectively to find the alpha terms, by the way, are you in PowerPoint and are you in Microsoft?
Yes, I'm using a PowerPoint on a MacBook.
Okay, because if it's on Microsoft, then you just have to type if you know the number of the slides you want to get to, you just type that number and enter and you get there. Now you're there anyway now, but
nice. Good to know.
It's a very useful trick. So you said that you'd sort of constrained some of the values to make sure that the parameter on fuel costs was never going to be negative. How often did those constraints actually bind?
That's a good question. I cannot give definitive values for that, but what I can say is that first we didn't impose those constraints. And for example, through the way data were on the false inference from the estimation, we sometimes add a negative value for fuel cost on the contribution of fuel costs, which can, by chance, let's say, improve the simulation results on the training data set. So that means that in sample it's really better and it's an overfit. And first, that will not generalize on the test set. And also that's the opposite of what we want to do with the interpretability and the but I cannot really say how often this was the case. It's just something that we eliminated because that was opposite to what we wanted to achieve.
Yeah, no, that makes a lot of sense. Now, I just wondered. The next thought related to this was how different were the alphas that you would get for different years? Were the parameters quite stable, or would the values for 2016 be very different from the values from 2018?
No, they could be different. That's also why we mitigate the issue not by learning over multiple years as suggested, but by in some cases by averaging the values of parameters often obtained with different training data sets as a way to mitigate these fluctuations. And you mentioned 2016, that's one case where we have really different values of parameters because of the spikes. So we have, relative to the size of the training data set, there were quite a lot of spikes, especially compared to other years. So we have a sensitivity to this data set.
Right, and is everything linear enough that sort of averaging parameters between the different years gives decent results?
Sorry, okay, could you repeat, please?
Well, I was thinking that the parameters that would work for one set of data would, if you then average across several different parameter sets, sometimes the function of an average isn't the same as the average of a function. That it's sort of that way around. But if everything is linear, then it would be.
Yeah, that's true.
So I wondered whether you had found that. Did you see how much of a difference it would make to use 2017 parameters on 2016 data, for example? I suppose that's in your learning or your testing.
Yeah, that's what we did. We didn't only simulate forwards. We also used the parameters of 2017 to simulate for 2016 and 15 and so on. And so, yeah, what we see is that we have some combination of years that works better. For example, 2015, 2018, even if they have the biggest gap between them, because they are the the price profile were similar in those cases. And here, just also coming back to the way that we perform the mean on the average, I think it will still be a bit more interesting to use a longer time scale for the training. It's an interesting perspective, because when what's not really visible on this this slide is that we have the regression, but on subsets. So really, we perform for specific hours corresponding to marginal production class, and so this is also part of the estimation algorithm. It's not akin to taking the whole data set and performing this linear regression. So when I think the size of the training is important, and especially now moving forwards, we have a better data sources that are more structured, better data quality, and now we can have from 2015 to 2021 with pandemic, war, and so we will have a variety of situation, and maybe with the increase of year, that will give more robustness to the approach on the fine estimation of parameters.
Yes, because I'd noticed that you were estimating some things on sort of relatively smaller data sets because of that, not the full 8760. But I think your time dummies, your 24 hours and your 7 days, I don't know. I think they were actually estimated on a full year, weren't they, at the end, at the bias correction?
Yeah.
And a little bit of me at first thought, are there too many of those? And then realized, no, actually, it's one. You've got 52 weeks for each of those parameters, which is fine. And then almost thinking, have you got enough of them? Because if you think about demand relative to demand over the rest of the day, today at 7 o'clock, it's going to be rather different from a 7 o'clock in January, and it's going to be rather different from a 7 o'clock in July. And having one beta for all 3 of them, yeah, I just don't know if that's the right answer. So that goes back to the president's comment about possibly estimating over short periods, or maybe it's actually overchaining several months that are similar, but from different years, so that you get the number of observations, but you're not trying to compare things that are very different or conditions that are very different.
But for example, what we can still infer, even if we have the seasonal variability, you will still find throughout the year similar patterns. For example, in France, that around 7 p.m. it's people go back from work, regardless of the month of the year, and they start cooking and using electric devices, and you will have increase of prices. So you have some aspects that are really sensitive to this seasonal variation, but there is some information to gather that are quite universal and not sensitive to this.
Oh yes, my particular example may not have been the best one, but I think you will. Yeah, there's definite differences in the amount of daylight by now. So yeah. Okay, another thought. You said that you tried estimating with different starting merit orders.
Yeah.
And so that was sometimes that was important. So do you think that implies the model's got a lot of local optima, so that if you start near something, if you start in the wrong place, it'll move you a little to the nearest local minimum or maximum, but you'll then miss away the main one? Is that what tends to drive it, or is it somehow that the function you've been optimizing is fairly flat, and so the model just doesn't bother getting closer? Have you got any thoughts on that?
Yeah, that's definitely why we perform the sensitivity analysis, because in iterative process for estimation, we see that the identification of marginal class was an important aspect. And if we wanted to see if we always converge to the same value, regardless of the initialization, and to find this final estimation. And what we see is now that we have to help the model by really giving it close to the one of the local optima that we want to reach, and else it will not converge to the value we expect. And it's hard to represent without drawing, but if you have your initializing point for the similar to what we do in gradient descent, you have to be close to what you are looking for. If it's not the problem is not totally convex, and that's what the sensitivity analysis tend to confirm.
Okay, thanks. When you did your Monte Carlo study of renewable outputs, I just had two thoughts about the way you were doing, what's the chance of each hour that, is there a danger that doing it this way, you suddenly, looking at the last 2 hours and the opposite diagonal of those two pinks, you could have had a scenario where you go from 12% to 46%, which would mean a lot of ramping. And so is there a risk that doing it this way, rather than just say, I will take this day and then that for the first 24 hours, and then some other random day for the next 24 from the right time of year, and then another day from the right time of year for the third day? Is there a risk that you're going to overestimate the impact of ramping constraints doing it this way, do you think?
Yeah, there is. The sampling was maybe a bit too abrupt to take individual hours, and you lose the temporal correlation. On using individual days or week instead of individual hours, you will have more. So you will have more correlation on more likelihood to have input time series that are even more relevant. You still have the problem that even when you change day, you can have this ramping, but it's but then also you can mitigate by doing a final regression to smooth the transition. And it's true here. It was a bit too.
So it's just
abrupt, this kind of sampling, but it doesn't change the philosophy.
No, it certainly doesn't change the philosophy. It's details. The other thought I had was doing it this hour by hour one may make it much less likely that you actually have a long period with very little renewable output, because you're always going to be sort of moving back towards the mean in each period. And so that may also make life look that one may make life look a bit easier, whereas the ramping things makes life look tougher than it really would be.
Yeah, you are definitely right. There is room for improvement for this kind of sampling.
That could be said of most of my papers. So room to improve. Okay, finally, and again, you might want to go back to slide 19 on this. Just 19 enter will get you there. If you had a keyboard.
Slide 9, right?
19, slide 19.
19, sorry.
So maybe you don't have a keyboard there. So I think you implied that you thought market power was going to be the residual that you hadn't been able to take into account. I don't know whether did you look at the pattern of residuals against sort of conditions on the system to see whether there was any correlation that might suggest that?
You mean a scatter plot between simulated price or residuals and
yes, sort of residuals versus demand or margin or anything else?
Yeah, we did, and that's why also I can confirm that the supply margin is one of the main elements that gives room from improvement, because we see that the regression is right on most cases, but the spikes are definitely linked, or there is more information to capture from this supply margin.
Yeah. Yes, I'd wondered about possibly having another term that would be the margin squared.
Yeah.
Or 1 over the margin or something like that, because market power tends to be very non-linear in the balance between supply and demand. So that was just a thought there.
Also, now from more conceptual point of view, I'm also I think something could be improved on the supply margin, but we cannot, I think, maybe expect it to work perfectly out of sample, because I was always a bit scared when doing so and looking at data, that I will implicitly overfit, even if I use a train and test set.
Yeah.
At sometimes I plot all the data and I will be tempted to say, okay, I will do a exponential curve and it works like that, or a sigmoid or whatever. And then we will see that because of completely other situation, it will not fit your data pattern in the future.
Yeah,
so
well,
I tried to refrain, but maybe I was a bit too conservative for this step. But I tried to refrain to stick too much to what I observed in the data set.
Yes, no, I think it's sort of if you're just bunging something in and hoping that the econometrics is helpful, that's a bad idea. If there's sort of a good theory for thinking this might be a case, then put it in, but sort of be willing to drop it if it does look as if you're overfitting, would just be a suggestion. Anyway, I need to allow other people to move on. So anyway, thank you very much for an interesting thesis.
Thank you for your questions.
Okay, so let me give the floor to Professor Pollitt now.
Thank you, and thanks to everyone else who's asked really good questions so far. So thank you, Valentin. I too enjoyed this thesis. Thought it was very well written, and I also enjoyed your presentation, which was very clear. Let me just ask my questions, and you can take them all together. I think I would have had a question about what is the point of this modeling? Okay, you know, are you trying to improve short-term forecasting accuracy, or are you trying to say something about long-term investability? Because normally in academic studies, we're more focused on, you know, can we predict prices to facilitate investment, particularly long-run investment in the energy transition? So I wondered what you were really trying to help with here. You might want to answer that. On page 22 in the thesis, you said the EU had the biggest market in the world. That's clearly not true. China does by far. So please correct that. In chapter 3, you started discussing your data, and you had some analysis. So on page 52 and 53, you actually reported some fitting. You didn't say what equation you were fitting. And you actually didn't say what was that the fit from the next chapter brought forward, but you didn't say what regression you were actually doing there. Related to my first question, in chapter 4, I'm not sure that the accuracy of the hourly prices is that interesting. Surely what's interesting is the accuracy of the fit of the average price. And I sort of wanted to know, well, okay, are you predicting the average price, average price across all hours, the average price for a renewable generator of a particular type? You know, because as an investor, I would want to know how accurate your average prices were, not just whether you reduce the variance of the prediction. So, you know, maybe on page 75, you need to say something about how accurate your average price was. And then in chapter 5, you move to this what if analysis, and I was really struggling with how that fitted with what you were really doing in the rest of the thesis, which was looking at short run forecasting accuracy. So what was the point of doing some extreme scenario modeling of the future and then you were presenting on page 97, which you actually had up on slide 36, you had a sort of weekly forecast of an extremely different electricity system from the one that you have now. And why would I be interested in a weekly forecast, which is, years in advance? I would be interested in how investable this was, how accurate, what are you predicting prices are going to be in 20 years time or 10 years time, when you might have actually realized the scenario that you were talking about, the what if scenario that you were talking about. And that was back to how accurate are your average prices and how accurate are they, how many years out. Now, I know you don't have enough data to tell me how accurate they are in 20 years time, but I sort of wondered what you were doing there. So, by the time you got to page 94 in your thesis, I imagine you were, okay, I want to finish this thesis. I need to, think of some other piece of analysis to do. I just wondered why you were doing that, why you didn't stick to variations of short run price forecasting accuracy rather than some extreme, never going to happen, what if scenario. So perhaps you want to address some of those questions. But as I say, I really enjoyed it, and it was very well written. So thank you for that.
Thank you for your question. I think I have to maybe to explain a little bit that it was mainly taught for long-term simulation. So there's this this concept to really keep in mind is that we want to do long-term simulation over fine time granularity. So have hourly simulation, but over a long time series. And why we want to do so? So you mentioned that there are a lot of models to do so, but there was a review paper from Thiel and al. that say that in the literature of forecast prices, there are a lot of models that perform very well on short-term timescale, and that's where you can use neural networks and a wealth of methods. But to have insight about possible future development of prices, that's where you can rely more on the structural models as presented here. And they are also used not only in academia, but by NSOE, so at the European level, and also from so there's a company like Plexos building this sort of tools, and they are used for investment decisions from market participants and so on. So there is a rationale why to, on an economic reason why to focus on this sort of models for long terms. Also, you said, I said the biggest market is EU. That's okay. I think I took this information from a report, and that's I have to go deeper because you are right with China. So it's biggest in terms of there should be a small footnote that I missed, and I will look into that to be more precise about this assessment. I will go back about the different correlation, but I will first the different question, but I will jump to the last one about the trajectories on this kind of scenario. So they were from the start of the project a key element of the modeling, because that's the entire reason why we want to build this kind of models, is that we want them to be useful for investors and for policymakers, in order to have information about possible future price development, so over the long term. And to do so, you need scenario on model. So these go hand in hand, and we wanted to illustrate how they perform. And I get your point about the average performance of the model. as a pure metric to say, okay, if you discuss with person interested in the model, you want to say, I have this metric that indicates that the model is performant or not. But when you want to really put it in practice, you need, for certain cases, to have this variability. You said, for example, the average price for solar, but then that means that we have somehow to look at the price and put it in regard with the production, as shown in the. Sorry, I get this bad habit of clicking. I have to switch to finding the right slide first. So here it was to illustrate that for a PV producer, the mean price is not that interesting. You want to know what will be the price when he will produce. So to put both information in regard. Same for storage. You don't generate revenue from an average price. This volatility is essential. So for example, the price spikes, it will be a gold mine today for storage asset owner. It could have a resell for this specific high value, and then sell back energy when it's a bit lower, and so on. So this variability for some evaluation of business case on policies are important. And just to go back to policies, for example, if we see that we have a cannibalization effect on the price would be really low, especially around 12 o'clock, that will maybe give an indication that support schemes are needed for photovoltaic, or that's not the only conclusion that we can draw from this kind of analysis. But that highlights why we want this kind of model and how we can use it. I'm not sure for chapter 3, you say the regression. I think I mentioned it, maybe I forgot, and I apologize for that if the case. If it's the scatter plot between prices on price drivers, it's a loss regression, so localized regression that and we also have the so that's the loss regression that's represented on this plot.
Yeah, but you don't. On chapter 3, you don't actually say what the regression is. You know that, which is very, you know, and actually in chapter 4, you don't. You also don't report regression actual tables, do you? So, which is very unusual. I mean, you normally expect any econometrics, you'd actually report the actual results table for the econometrics.
Okay, so sorry for that. Yeah.
Okay.
Yeah, I try to write your question as good as possible, but
yeah, thank you for that.
I mean, I try my best to reply to all. So
yeah, thank you. I mean, you know, it's worth. You've got this slide up. I mean, just to say, it clearly isn't the variance that matters by itself. You could have looked at the average prices, and you know that most studies of net zero try to do that. You know, they actually do look at what's the average price that's received by a particular type of generator. And, you know, this solar generator has very predictable availability across the day. And you know which hours it's going to be generating in, and you want to know. I think you do want to say something about what the average price it can expect is. I don't think you answered my question. Did you answer the question about the what if analysis? So why did you do that?
That's something that's really I would say typical. For example, if you and SOE is even has to do that. They make the 10-year network development plans, and they propose different scenarios, and they say, okay, what if we go to a new technological choices with a renewable or nuclear, or could we reduce demand? Can we increase sector coupling? And they made this kind of big picture case where they say that would be the general trajectory that we want to adopt, and they compare the scenario. and then they create inputs corresponding to the scenario, and they simulate with the model and analyze the results. And that's something we see, for example, for net zero from the International Energy Agency, or RTE.
Yeah, but normally we see it on a 20-year time frame, don't you? Whereas what you do, you're doing it with 2018 data.
Yeah, no, it's not. Not only
you have to model the 20 years out to when you actually deliver the new scenario, don't you?
Yeah, it's the. Okay, so maybe I didn't get the question. I think the scenario approach is illustrated here, and then to make more comprehensive on more detailed analysis that can really guide policy decisions, we could increase the size of the time span of the scenario. So I agree that you cannot just take policy decisions on what has been presented here. It's illustrative of how you can use the method, and then it goes again. The scenario are built by it's work from dedicated team for itself, just building it. So there was a RTE doing so on ADEME recently for the ecology agency in France, and so the scenario can be complexified, as mentioned, with other open data and on even rely on closed data sources. So yeah,
but it was a funny use of your modeling, given that all of the rest of it was emphasized short run forecast accuracy. I mean, a more obvious thing to do would be, well, what if suddenly we have a huge new interconnector to the UK, or we have one discrete new investment? What difference would that make? We have a 2 gigawatt new pump storage power plant in France. That would have been a more obvious use of short run.
Yeah, okay, but it's true that you can also draw information about specific events. But what we wanted to propose, and you can use the model for both studies, but we wanted to propose evolution of the power mix and to see what could be the link between power system, energy market, and so on, and then draw analysis from that. But maybe I didn't convey the point as clearly as intended.
Great, thank you. Thanks very much for answering the question.
Thank you too.
Thank you. So now the floor is the last member of the committee, Director Vassilopoulos.
Hello. Can you confirm that you can hear me well?
Yeah, it's perfect.
Thank you. Thank you very much. Valentin, thank you very much for this presentation. I think it was very interesting, and the reading of your PhD also was very interesting. My take is a very high level that you're bridging the gap between supply stack models and econometric/machine learning models. And today, every department in trading or analysis of the power market has 2 models. And here you're suggesting to almost in a simplified way, to bundle them into one, and to determine the characteristics of the prices, and especially the structure of the prices within the day and within the year, to project, to be able to say some things about the future. So I think this is a very valuable exercise that you're doing, and it also allows to extract as much information as possible from the current prices. So from an empirical point of view, I think this is very valuable, because it helps get some information that are totally missing from supply stack models that we usually see, which are basically optimization models. So this is a very an important added value of the work you have done. I have two caveats here, which I think are quite key. And of course, you do mention them. So it's clear, it's explicit. But I was a bit, let's say, disappointed that there isn't a little bit more on them. And the points have been raised by almost each member of the jury. And I tend to talk about, I mean, I talk about the storage value, and this is true for hydro. In particular, in countries like France, the importance of the storage value is significant on prices. And and it's very difficult to understand how prices form without having a good representation of what is the water value, basically. And to my knowledge, without any dynamic programming and computing Bellman values there, you just don't capture that. So my first question would be, how do you compensate these missing hydro values? Because if you don't get these right, unfortunately, there's little you can say between, for example, the point that Yannick was making about the extent of market power and its exercise, which could create a difference between the outcome you got and what's been observed on the market. So this was my first point. And it's true for hydro. It's more and more true for nuclear also, which is also to a large extent run under the storage values because of the uranium stock that is just not infinite. So this is my first point. The other one is certainly on the price spikes, and it's true. You point out that the price spikes are difficult to capture, but I think you could go a little bit further at least in the discussion, not necessarily the quantification for the short term, because you mentioned non-linear elements of the model that could capture that. But it would be at least useful that in your PhD you say a little bit more about what you've tried, why it doesn't work, and give more statistical elements, because this is really the key characteristic of a power market are the price spikes. So one thing is difficulty to capture them. The other thing is to some extent putting it aside. And I think you shouldn't put them aside. I would specifically point this out towards the future and prospective work, that it's really missing the discussion on what is the impact of not being able to capture well price spikes on the impact on the prospective work you're doing when you're trying to go forward. Because forward looking indeed is very important for investors, but the price spike is the main element for investment. To a large extent, these price spikes are bringing the inframarginal rents that all technologies are needing, and some of them are cruelly missing these, because without them, they would just not invest in the market. So I think this is important, not necessarily in a quantified way, but at least in the PhD, there is a bit of the discussion on how this is tackled for the prospective part of your analysis. So basically the forecast you're doing. And the other comment that I have is regarding the prospective work, because I think this is really the added value. You're saying, well, I get some a structure of prices that allows me then, based on scenarios, to look at what these, to understand what these are looking like in the future. And the main point that I have here is that unfortunately things are not always equal. Actually, the markets show that things are never equal, all things equal, because market participants will tend to react, to adapt to the situations. And this is something that from the power exchange perspective, we see a lot, that the market is reacting a lot. And that means that taking some characteristics of the past and projecting them in the future might underestimate the ability of the market to adapt to the situation. And therefore, maybe what could be useful at the end of this PhD is really a bit of a discussion on the configurations, or Yannick also mentioned this term configuration. I would also like to say the constellations in terms of gas, CO2, supply-demand margin that leads to the outcome that you have in mind, that the model shows. And that could be useful to not consider that all things are equal, because unfortunately they're not in real life. So these were my few comments in a way the questions that I have for you in how do you want to integrate these elements in the PhD, or what kind of future research? You are opening some elements for future research, but I think here it could be interesting to go also one step further and point out how important these elements are. The storage values and the spikes, and some ways to take them into account. Thank you very much.
Thank you for your question. So for storage first, yeah, as you mentioned, we have we try to account for the value of water, but in a simplified fashion. And the way would be to go deeper, but that's why. So as we know, it's a really complex system with so many interactions. So we can go deeper in the modeling of the hydro or the temporal scale, on the going for Europe, the interaction with other electricity market, the interaction with gas. And at some point, it's too much. So it's we have to think what's the most important. And what we propose here is okay to say storage is really important, but we will start on the see if we can capture the dynamics with something simplified, because we don't want to perform a unit commitment. We have to keep the final objective in mind, is to simulate accurate prices. And as we see, there is still room for improvement, and improving storage could be one for spikes and so on. And regarding the spikes and the discussion, so we already say that there is possibility to improve the formulation of the for example, the supply margin term. That is, in my opinion, the most important one. And I tried some alternative modeling, and to go. We discuss with my supervisor, and we also even work with a student, a master student, on this point. So the problem is that, well, it's hard then to try at the same time to capture most prices and to find so the let's say the average price is on the spikes. And maybe by testing a lot of models, I could finally have the one that fits really well. And maybe I could have go deeper in that way. But I think maybe what would be interesting to use in prospective mode is not to try to really simulate the amplitude of spikes that is really hard to know in advance, because there's so many gaming, and I think it would be almost impossible to pinpoint each spike. But figuring out when price might occur is a bit easier. And what we can propose is to say, we have the output of our model, then we have a flag, say, be careful, there will be a spike probably. And then to have different branching, and to say, okay, we have a spike, and then using a fuzzy logic, for example, or other kind of model as plugged to the output, and say, now there is a spike, and we say it's we'll simulate 10 cases where it would be a big one, a few cases would be not significant, on a few cases where we missed and there is no spike. Then we will have a new time series as for Monte Carlo, and then we can simulate a new, and we can. So then we switch the complexity. We don't have to have a model that makes all possible, but then we add a model chain and say something specific if someone is interested, or many people are interested in this kind of studies. Also for the reaction of market participants, so that's true, they adapt the strategy. And I think to really go deeper, we would have to maybe introduce notions from game theory, but then again, we will have both the statistical optimization and game theory approach, and at some point you will find maybe instabilities or too much complexity. And I think what could be interesting is really to keep in mind that, and maybe it could be better capture, but what I would like to do if going further, it's maybe to try to really analyze what are the key decision factors for traders, and to say what doesn't change over time. So they want to minimize risks, optimize profit, or some aspects that are quite general, so not subjective to structural events, and to say, how can we keep this ground truth and represent it in the model? So that's how I will proceed to I'll not go too much into the specificities, or maybe say they are just modeling a virtual other market to give more flexibility and say, okay, there is arbitrage possible to switch from day ahead to intraday, or to switch demand from gas to electricity for specific industrial process. This kind of giving flexibility to the model, but at some point stopping to increase the complexity of what we propose, but to integrate it within a model chain. And that would be my last answer.
Thank you very much, Valentin.
Thank you for the questions.
Okay, thank you very much to all the members of the committee. And now we can open to the audience for 1 or 2 questions, since we would like to keep the timing of our timetable. I don't know if there are questions from the audience. I remember that only people with a PhD can ask questions. Okay. As far as I understand, there are no questions from the audience. And therefore, we can conclude this discussion.
Thank you very much.
Thank you very much.
Thank you.
So we can move to the other link for our meeting. Thank you very much and goodbye.
Okay. Thank you.
Okay. Now I will give the mic to George so that he can say a few words. Ouais. Okay. Du coup là on sort tous ou comment? Ouais.
Hello, for those who are connected also to YouTube, this link will remain open, and it will take us something like, I don't know, a few hours, no, 40 minutes, let's say, or 40 minutes for deliberation. So we'll come back here for the result. Hello, do we have all the jury connected or not? Robin, Léo. Hello, I'm not sure if we have all the jury connected. Angelica, I think it's... We need the president. Robin, you can see if the persons who are connected, because we cannot see at the screen now. It's...
I don't see Angelica indeed. But otherwise, all the jury members are here. I'm going to send the link again to Angelica.
Yeah, send her the link because I think she has connected to the other one, to the... And Yannick is not...
There
you can send to Yannick also in...
No, Yannick is here.
Okay.
Oh, sorry, Angelica is here also. So everyone is here now.
Okay, perfect. So we put... So everybody is here. So we let Angelica...
Read
Angelica,
the report.
can you hear us? Oh, yes,
Yes.
Okay, now it's good. Thank you.
Okay. So let me read the report that we just wrote. Mr. Mahler presented his thesis modeling the evolution of electricity prices in a context of high penetration of renewables in electricity markets. Today, the 4th of April, 2022. The subject of the thesis is important as future electricity prices will affect the profitability of electricity generators and the welfare of electricity consumers. The jury convened and agreed that the candidate provided a significant and original contribution beyond the state of the art and with emerging real-world impact. He gave a good presentation of his thesis with clear, well-designed slides to help get his points across. The rapporteurs and examiners asked a wide range of questions, which covered the aim of the thesis, the methodology, the results, and some suggestions for future work. He gave good answers to all of these questions, justifying the methods that he had used, but open to questioners' suggestions. It was clear that Mr. Mahler was fully in command of his material and the topic more generally. The jury considers that these answers were very satisfactory and honest, and fully met the standard that would be required in a public PhD defense. In summary, the jury agreed that this research represented a significant and original contribution. Therefore, the jury unanimously decided to award Mr. Valentin MAHLER the grade of Doctor in Energy and Processes of Paris Science et Lettres University, prepared at Mines Paris Tech in the frame of the doctoral school number 621. Last but not least, the members of the jury congratulated personally to Mr. Valentin MAHLER for the excellent presentation and research work, which is further endorsed by publication in a high-impact scientific journal.
Thank you very much. So thank you for these nice words. I would like to thank all jury members for their interest in the topic and the presentation, and also all the questions and answering debate. And more precisely, special thanks to Georges and Robin for supervising my thesis throughout these years. And now, if you don't mind, on the more personal note, I will switch to my mother language and continue to thank other people in French. Pour commencer, je voudrais remercier mes parents qui, malheureusement, à cause d'un énième rebondissement dû à la crise du Covid, n'ont pas pu être présents physiquement aujourd'hui, mais je sais qu'ils me regardent sur YouTube. Et je tiens à vous faire un gros bisou et vous dire merci pour tout sur mon accompagnement lors des études et professionnelles et bien évidemment largement au-delà de ça. Et voilà, donc je sais que le buffet se fera vite attendre, donc je vais essayer d'être concis dans mes remerciements, mais je pourrais passer bien plus longtemps pour vous dire à quel point je vous aime et plein de belles choses. Évidemment, Mathilde, un gros bisou aussi et un grand merci. Je ne m'étends pas plus longuement, mais je suis très content que tu aies pu aussi faire le déplacement aujourd'hui. Je ne peux pas m'empêcher de dire aussi un mot pour ma belle famille, donc mes beaux-parents qui étaient là il y a quelques instants, et aussi Laure et Nico qui m'ont aidé à travers tous ces travaux, pas plus tard que hier encore, pour servir de cobaye à une dernière présoutenance. Donc, un grand merci. Thomas, ça fait toujours plaisir, là dans tous les beaux moments. Les autres, un grand merci d'être venu. Et à tout à l'heure. Les collègues et amis du labo, à la base, je voulais essayer de vous remercier individuellement, et j'ai réalisé qu'il y avait tellement de monde que c'était pas forcément souhaitable. Donc sachez que je suis très content d'avoir passé ces moments avec vous, même s'il y a eu beaucoup de télétravail dû à la situation actuelle. On a eu des échanges sympathiques sur à la fois personnel, et j'ai eu beaucoup d'aide grâce à vous aussi pour la modélisation. Et quand même un mot particulier pour mes collègues de bureau, Fian, Stefano, Kevin, Onxi, donc un grand plaisir de tous les instants. Et j'oublie pas non plus ceux qui ne sont plus au laboratoire actuellement, mais qui m'ont aidé à m'insérer, à m'intégrer dans cet environnement de travail, à commencer même par m'introduire au sujet de thèse. Et voilà, un grand merci à eux tous. Aussi, sur la contribution au bon déroulement du travail, je voudrais remercier l'ADEME et Armin qui ont financé ces travaux. Je remercie à nouveau, et particulièrement, sur une note plus personnelle, Brice et Valérie de l'ADEME qui ont vraiment aidé à ce que tout se passe bien. Et aussi, donc, du côté des mines, beaucoup de monde, le comité de suivi avec Fabrizio et Alexis pour aussi leurs commentaires pertinents, Isabelle Iota et Magali pour les activités qui permettent un peu de sortir purement des aspects scientifiques, mais les cours de théâtre, de chant, et qui permettent aussi de rencontrer les gens des autres laboratoires. Et au sein même de notre laboratoire, tous ceux qui ont rendu ces choses possibles, comme Arnaud et Laurent, qui a toujours été non seulement très sympathique, mais toujours prêt à aider pour tous les problèmes qui pouvaient se poser sur le plan technique. Et finalement, en espérant n'oublier pas trop de monde, et remercier tous ceux qui sont présents et tous ceux qui ont la possibilité ou qui regarderont en différé cette vidéo. Donc, un grand merci à tous, et encore une fois, Georges et Robin, et de m'avoir permis de réaliser ces travaux et sur un sujet extrêmement intéressant et riche.
Okay, merci Valentin. We wish you all the best for the next of your career. We know already that maybe some information for the jury, but I let you say yourself what you are doing now, just for some information for the jury.
Me? Yeah, sorry. So now I'm pursuing in academia, but on a slightly different topic. So still using data science, but to try to predict if there is, to make diagnosis based on the lung scan, to assess if we can find, using computer vision, indices that could be a cancer. So using artificial intelligence in order to detect the possible presence of a cancer.
So this supposition at the university here in the area in Nice.
Exactly. It's the sorry. I didn't prepare this presentation, so I just yeah, to give a few more words. Yeah, it's a project that started in 2018 at the Université Côte d'Azur. So the main campus is based in Nice, so really in the area. And it's a really interesting subject that from the mathematics and the methodology will be a continuation of what I could learn during the PhD.
Great. So thanks. I would like to thank once more all the members of the jury for your time, for your participation, the effort to read the report and ask questions today. And we hope to meet again physically at some other occasion. Thank you.
Thank you.
Thank you very much.
Thank you.
Thank you. Thank you. Goodbye.
Goodbye.
Bye.
So it's a pity that they are not here, but we will share the buffet for them.
Et dès que la photo sera prise, je vous invite à vous diriger vers le buffet.
Ouais.